I was looking through this stack of documents we have for today, the FinCEN advisories, the real estate reports, the compliance manuals, and a very specific detail just jumped out at me.
Let me guess. Was it the $1 billion laundered through Australian real estate?
Hmm.
Because that one's a headline grabber.
No, actually, it was smaller, much smaller. It was the price of a washing machine.
A washing machine. Okay, you have my attention.
Yeah. Right in the middle of this huge, very dense advisory on something called the black market peso exchange, there's this detail about how drug cartels are basically becoming like the world's most inefficient appliance retailers.
Huh?
And it just made me realize we tend to think of money laundering as this sleek Hollywood kind of thing, Guys in bespoke suits tapping on laptops in the Cayman Islands, moving millions with a click.
Right, the Wolf of Wall Street fantasy.
Yeah.
Or, maybe Ozark, where you're just stuffing cash into the walls of a funeral home.
Exactly. But the reality is so much messier, so much more mundane. It's refrigerators, it's recycled bank account numbers, it's grandmothers buying penthouses they've never even seen. It's this whole global industry that uses the most normal things to hide the most illicit profits.
That's the perfect way to put it. It's the friction point, right?
Yeah.
Between the criminal underworld and our the upper world of legitimate finance.
Right.
And I think what we're trying to do in this deep dive is really get into the mechanics of that friction. How do you actually move $1 million of dirty cash into a clean bank account without tripping a single alarm? Because looking at the Unit 21 breakdown and the first AML data we have, the whole system is designed to catch you. It's a massive surveillance net.
And yet trillions slip through every year. So yeah, we've got a heavy stack today. We're going to look at the life cycle of dirty money, the specific real estate loopholes that are driving regulators crazy, and then this completely wild trade-based system the cartels cooked up.
But we have to start with the fundamentals.
The framework, yeah. Because if you don't understand the 3 stages, nothing else really makes sense.
It creates the necessary scaffolding, for sure. The experts, and for this we're drawing from a breakdown by a group called Unit 21, they universally categorize laundering into 3 distinct phases.
Placement, layering, and integration.
That's it.
So let's walk through the life of a dirty dollar. Stage 1 is placement.
Right. And placement is, it's exactly what it sounds like. It is the physical act of introducing dirty money,
Right.
So cash from illegal activity into the legitimate financial system.
And from what I'm reading here, this seems to be the most dangerous phase for the criminal. This is where the rubber really meets the road.
Oh, it's absolutely the point of highest vulnerability. Because cash is bulky and cash is suspicious. If you walk into a Bank of America with a duffel bag holding $1 million in 20s, you are not leaving without a very serious conversation.
Yeah.
Probably with the FBI.
Probably, yeah.
So the whole goal in the placement phase is just to get that physical currency into a digital format or maybe an asset without triggering the mandatory reporting thresholds.
Okay, so let's talk about how they do that. One of the classic techniques mentioned is disguise deposits, or what they call smurfing. And I've always loved that term, but the math of it actually sounds exhausting.
It is incredibly labor-intensive.
Yeah.
Think about it. In the U.S. and a lot of other countries, there's a hard line. Any cash transaction over $10,000 gets automatically reported to the government.
A currency transaction report, a CTR.
Exactly. So if a criminal has, say, $100,000 to move, they can't just deposit it. It's an instant red flag. They have to break it down.
So they break it into, 11 deposits of $9,000?
Well, even that might be too obvious. The software is smart enough to see patterns. So they might break it into 50 deposits of $2,000 each, or 100 deposits of $1,000.
And you can't just go to the same teller 100 times.
Oh, no, absolutely not. You have to go to different branches, different banks, maybe even different cities. You hire a team of people, the Smurfs runners, basically, to go out and make these tiny deposits over weeks, sometimes months.
It's death by 1,000 cuts. Or, I guess, laundering by 1,000 deposits.
Precisely. And that's just one method. Another really common placement tactic is blending funds.
Right. This is where you own a legitimate, cash-heavy business.
Yes. A restaurant, a nail salon, a casino, a car wash, or, of course, a laundromat, which is where the term comes from.
It makes sense. If I own a pizza place, who's to say exactly how many pepperoni slices I sold on a Friday night? There's no perfect record.
That's the beauty of it for them. If your restaurant genuinely makes $5,000 on a busy Friday, you just throw in an extra $5,000 of drug money and deposit $10,000 total.
And to the bank, it just looks like you had a really good night.
Wow, the new pizza special is a hit. The dirty money is now official revenue. It's inside the system. It's been placed.
And then, of course, you have the more physical methods mentioned in the source, like just straight up cash smuggling, which sounds crude, but I guess it still works.
It works because borders are porous. And sometimes it's not about getting it into a bank right away, but just moving it to a jurisdiction with, uh, shall we say, more flexible regulations. A place where asking questions is discouraged.
So you can place it there more easily.
Exactly. Or, and this is very common, you purchase assets. You take the cash and buy things that hold value and are easier to transport. Gold, diamonds, high-end watches, artwork, or even just money orders from the post office. $100,000 in money orders is a lot easier to stick in a suitcase than a stack of loose bills.
Okay, so that's placement. The money is in the system, but it's still sitting there. And if anyone looks too closely, like an auditor or a forensic accountant, they might see the sources a little weird.
It's still too close to the crime.
Right. So that leads us to stage 2, layering.
The layering stage is the shell game. It is all about confusion. The goal here is to create distance. You want to build a paper trail so complex, so winding, that if an auditor tries to trace the money back to its origin, they just get lost in the maze. They give up.
And the source lists electronic transfers as the primary weapon here, which makes sense.
Speed is the key. They move funds rapidly between dozens of accounts, often in different countries, through shell corporations. By the time authorities get a warrant for an account in country A, the money's already in country B. From B, it goes to C, and then it gets split into 4 different accounts in country D.
You're chasing a ghost through the global financial system.
It's a digital fog. And the source also mentions cryptocurrency as a major tool for layering now.
I was going to ask about that. I assume it's because of the anonymity.
It's the perceived anonymity. It's not as anonymous as people think, but it adds incredible complexity. If you can trade your fiat currency for Bitcoin, move it across different wallets, use a tumbler or a mixer to shuffle it with other people's crypto, trade it from Monero, then trade it back, you've just added a significant digital barrier for investigators.
Wow. But they also use really traditional stuff too, like financial instruments, buying stocks, bonds, and life insurance. How does life insurance work?
Life insurance is a classic move. It's surprisingly effective. You take your placed cash and buy what's called a single premium life insurance policy. So you pay the whole policy off in one go.
Okay.
Then you wait a month, maybe 2, and then you cancel the policy.
Or they just give you your money back.
Well, you pay a penalty fee for early cancellation, sure. But the insurance company cuts you a check for the remaining balance. A nice, clean, legitimate check from a major insurance corporation.
And that check is completely clean.
Bulletproof. If anyone asks, where did you get this $500,000? You just say, oh, I cashed out an insurance policy. It looks like a normal, if maybe slightly poor, investment decision. Not a Drake deal.
That's brilliant. Which I guess brings us to stage 3, integration. This is the payoff.
This is the finish line. This is where the money re-enters the legitimate economy and it appears fully clean. The criminal can now spend it on a mansion, a yacht, invest in the stock market, start a business, anything without fear.
And the source mentions a really interesting concept here called shrinkage. It sounds like something from a retail store's inventory, but it means something different in this context.
Yes. And this is crucial if you want to understand the criminal mindset. They expect to lose money during this process. They don't get 100% of it back.
From all the fees and penalties.
Exactly. From transaction fees, bribes to gatekeepers, bad exchange rates, those insurance penalties we just mentioned. They might lose 10%, 15%, maybe even 20% of the total value.
So they don't see that as a loss.
They see it as the cost of doing business. It's a tax on crime. It's the price of cleanliness. Think about it. They would much rather have $800,000 of clean, spendable, investable money than $1 million of dirty cash buried in the backyard that they can't touch without getting arrested.
That makes perfect sense. Legitimizing the money actually adds value to it, even if the face value goes down.
Precisely.
Now, speaking of integration, one of the biggest, most popular, and most effective ways to integrate dirty money is real estate.
Real estate is the golden goose for laundering. It always has been.
We're looking at a pretty detailed report here from First AML, and they really dive deep into this, and the scale is just staggering. They cite a statistic from Austrac, that's the Australian regulator, estimating that in 2020, Chinese interests alone laundered about $1 billion through Australian real estate.
Just one country in 1 year. It's a staggering number.
Why real estate? What makes it so perfect?
The report highlights this great combination of factors. First, You're dealing with huge sums of money. It's a way to clean millions at a time, not thousands. Second, the transactions are inherently complex. You have lawyers, escrow agents, title companies, lots of people involved, which can muddy the waters.
And historically, it's been underregulated compared to banking.
Exactly. For a long time in the U.S. and elsewhere, real estate agents just didn't have the same strict reporting requirements that bankers did. It was, as the report says, perfect conditions for laundering.
So let's break down the tactics that first AML outlines. The first one they mention is third-party purchases.
This is the most straightforward method. It's basically using a front man. In the industry, they're sometimes called a clean skin.
A clean skin.
Yeah, it's someone with a clean criminal record. It could be a complicit friend, a family member, or just some random person you pay a fee to. A student, a retiree, anyone whose name won't raise red flags.
So the criminal provides the cash under the table, but the clean skin is the one who signs all the papers and whose name is on the title.
Exactly. The criminal's name never appears on a single official document.
Yeah.
As far as the authorities are concerned, this nice grandmother from Omaha just bought a luxury penthouse in Miami.
And the criminal effectively controls the property. They live in it, or they collect the rent. But on paper, they are completely invisible.
Invisible.
Okay, the second tactic is really clever, and I want to drill into this one because it took me a second to wrap my head around it. Laundering through loans.
Right.
Because on the surface, it seems totally counterintuitive. If I'm a criminal and I'm sitting on a giant pile of cash, why on earth would I take on debt? Why get a mortgage? Why would I want to pay interest to a bank?
It does sound backwards, doesn't it?
Yeah.
The logical thing would be to just buy the house outright with your cash and be done with it.
Right.
But think about the paper trail. If you try to buy a $2 million house with actual cash, that is a massive blinking neon red sign to every regulator in the country. Alarms go off everywhere. The question becomes, where did this guy get $2 million in cash?
You trigger every reporting threshold in the book?
You're practically begging for an audit. But what if you do it differently? What if you put down a legitimate 20% deposit, say $400,000? Maybe that's money you've already cleaned through a front business.
So the bank sees you as a standard borrower.
They see you as a great borrower. You've got a huge down payment. They are happy to give you the mortgage for the remaining $1.6 million. Now, you have a legitimate debt to a legitimate, highly respected financial institution.
Okay, so I have the house and I have the mortgage. Where does the dirty money come in?
And here is the magic trick. You don't pay off the loan with a big wire transfer. You service the loan month by month using the dirty cash.
Ah, I see. So your monthly mortgage payment might be, what, $5,000 or $6,000?
Exactly, which is way below the $10,000 reporting threshold. You are effectively using the bank as a slow-motion washing machine. Every single month, you feed a little bit of dirty money into the loan. The bank absorbs it, digitizes it, and marks your loan balance down.
And then, say, 5 or 7 years later, you sell the house.
You sell the house, and the check you get from the sale,
It's clean.
perfectly clean. It's equity. It's capital gains. You can take that check for, say, $2.5 million to any bank in the world and say, look, I sold my house, and the paper trail is completely bulletproof.
That is just insidious. It weaponizes the bank's own lending products against them.
It creates this veneer of legitimacy that is just so hard to pierce without a really deep, time-consuming audit.
Okay, then we have property price manipulation.
This sounds like it requires a bit of help from the other side of the transaction.
It usually requires a complicit seller, yes. And there are two sides to this coin. You can do undervaluation or overvaluation.
Walk us through undervaluation.
Okay, so let's say a house is worth $2 million on the open market. The criminal goes to the seller and makes a deal. They say, we're going to put $1 million on the official contract. That's the price we'll file with the land registry.
But the seller isn't going to just accept half the value of their house. Of course not. So the criminal slips the seller the other $1 million in cash under the table. A bag of cash.
So the seller gets their full $2 million, and they only have to pay capital gains tax on $1 million of it. So they're happy.
They're happy. The criminal is happy because they now officially own a $2 million house that, on paper, they only paid $1 million for. Sometime later, maybe a year, the criminal sells the house for its true market value of $2 million.
And on paper, they just made a $1 million profit.
A completely legitimate profit from a savvy real estate investment. They've turned $1 million in dirty cash into $1 million in clean capital gains.
And what about overvaluation? What's the point of that?
That's usually about getting more money out of a bank and into the system. You might buy a cheap, rundown property at a hugely inflated price. Maybe you secretly control the show company that's selling it to you, so you can justify getting a massive mortgage from the bank. It allows you to move larger sums of money into the property market to then slowly layer them out through those loan repayments.
The report also mentions buyer collusion. This sounds like something that would happen at an auction.
It is, almost exclusively. Imagine you're at a property auction, and you see 5 different people all bidding fiercely for a house.
It looks like a hot market.
Right, but what if all 5 of those bidders are actually working together? They can artificially drive the price up to wash more money through the final sale price. Or they can manipulate the bidding to make sure one specific person wins the auction at a specific price, all while making the transaction look totally legitimate and market-driven.
It's a choreographed performance.
Exactly. And the last one here is successive on-selling, or just flipping. This is the rapid-fire approach.
Yeah.
You buy a property and then very quickly sell it. Then the new owner sells it again and again. Often these sales happen between a network of related shell companies or trusts.
And each sale adds another layer.
It makes the water muddier and muddier. If an auditor tries to trace the original funds, they have to peel back 3 or 4 different sales in just 6 months. And each sale creates this illusion of legitimate profit. Oh, I just made a good trade. Over and over and over. It's all about creating distance.
It's incredible. So real estate is clearly a massive vehicle for this, but I want to pivot now to what I think is the most fascinating document in our stack today. This is the FinCEN advisory on the black market peso exchange.
A BMPE.
Yes.
This is legendary in the world of financial crime. It's arguably one of the most sophisticated and efficient laundering systems ever devised.
And the document focuses specifically on Colombian drug cartels. What struck me is that this isn't just a scheme, it's a full-blown alternative economic system. It's like a shattered banking network.
It really is, because it was born out of a very specific fundamental problem for the cartels. If you are a Colombian cartel, your product cocaine is sold in the United States. So you are sitting on mountains of US dollars in cash in Miami, New York, Los Angeles.
But all your expenses are back home.
All your expenses are in Colombia. Your labs, your payroll for your soldiers, your bribes, your lifestyle, it's all paid for in Colombian pesos.
And you can't just FedEx a few $1,000,000 in cash to Bogota every week.
I mean, you could try, but that is extremely risky. Cash is bulky, it's heavy, and if a shipment gets seized at the border, you lose 100% of your product. It's gone.
So you have a currency mismatch. You have dollars here, but you need pesos there.
Exactly. So the black market peso exchange was developed over decades to solve this very specific currency mismatch. And the genius of it is that it effectively swaps the money without the money ever physically crossing the border.
Okay, let's break down the mechanism because the advisory lays it out step by step, and it's pretty wild.
Let's do it. Step 1. The cartel sells drugs in the U.S. and accumulates a huge pile of dollars. Step 2. The cartel's financial manager contacts a peso broker in Colombia. This broker is the linchpin of the whole system. He is a specialized kind of financial criminal.
So the cartel guy says, I have $1,000,000 in cash sitting in a stash house in Miami. I need pesos in my account in Medellin.
Right, and here comes the swap. The cartel agrees to sell those U.S. dollars to the peso broker. But, and this is key, they sell them at a discount, a pretty steep one. Maybe they sell that million U.S. dollars for only $700,000 worth of pesos.
That's a 30% haircut. That's the shrinkage we were talking about.
That is their cost of doing business. And then you get to step 3, the payout. The broker, using his own clean funds in Colombia, immediately pays the cartel their pesos.
And this is the crucial moment for the cartel, right?
It's the magic moment. The cartel is now out of the loop. They have their clean pesos. They're happy. They're safe. They can go pay their bills. Their problem is solved.
But wait, now the broker has a huge problem. He just paid out $700,000 worth of his own clean money. And in exchange, he now owns $1,000,000 of dirty drug cash sitting in a house in Miami. He's taken on all the risk.
Exactly. This is step 4, the risk shift. The broker has assumed all the risk. Now he has to figure out how to clean those U.S. dollars and get them back to Colombia to make his profit.
And this is where the washing machine comes in.
This is where the washing machine comes in. This is where the genius of the system really shows. He doesn't just try to smurf it into a U.S. bank and wire it home. That's too risky at this scale. He uses trade-based money laundering.
The laundry phase.
Right. The broker has a whole list of clients in Colombia. These are legitimate business owners, importers, who need U.S. dollars to buy goods from America.
Like appliances or electronics or textiles.
Exactly. Maybe they want to import refrigerators or computers, but perhaps they can't get U.S. dollars easily through official channels. Or maybe they just want to avoid import taxes and regulations, so they go to the broker.
So the broker uses the dirty drug money sitting in Miami to buy legitimate goods in the U.S.
Yes. His associates in the U.S. take that dirty cash, they place it into the U.S. banking system, often using those very same smurfing techniques we talked about, structured deposits under $10,000. And they use that placed money to pay U.S. manufacturers for goods.
That is incredible. So the cartel's drug money literally buys 500 washing machines from a factory in Ohio.
Correct. Those washing machines are then legally exported and shipped to the legitimate importer in Colombia. That's the import phase. And finally, to close the cycle, the Colombian importer pays the broker in pesos for the shipment of washing machines.
So the broker gets his pesos back, plus a hefty profit, and the dirty U.S. dollars have effectively been transformed into appliances and then back into clean pesos without ever crossing the border as cash.
It's brilliant because it separates the narcotics nexus, the drug connection, from the money almost immediately. By the time the money hits that U.S. appliance manufacturer, it just looks like a standard payment for an export order. It's propping up legitimate international trade.
And the advisory does mention that within this huge system, the brokers still have to solve that initial placement problem in the U.S.
Right. They still have to get that pile of cash into a bank account to pay the manufacturers. The advisory notes they use structured transactions. They commingle the drug cash with receipts from a legitimate U.S. business they control, or sometimes they smuggle the cash out of the U.S. to a nearby country, wire it back in to look clean, and then make the payment.
It just makes you wonder how much of the global trade system is actually being greased by this kind of shadow finance?
That is a very significant concern for regulators. It's why trade-based money laundering is considered one of the hardest forms to detect. How do you find it? You're looking for value discrepancies in millions of shipping containers. If a container of teddy bears is priced at $500 per bear, okay, that's an obvious red flag.
Right.
But if it's priced normally and the money source is the only issue, that is finding a needle in a global haystack.
Okay, so we've seen the crimes, we've looked at the 3 stages, the real estate tricks, and these incredibly complex trade systems. Now we need to look at the other side of the battlefield, the watchdogs.
And for this, we have a lot of data here from FINRA, the Financial Industry Regulatory Authority. They are on the front lines making sure that brokerage firms and financial institutions aren't being used for this stuff.
And everything seems to pivot around something called the Bank Secrecy Act, and specifically, FINRA Rule 3310.
Rule 3310 is the cornerstone of their enforcement. It requires every firm to have a written anti-money laundering, or AML, program. But the key phrase in the rule, the one that compliance officers lose sleep over, is that the program must be risk-based.
What does that actually mean in practice? It sounds a little vague.
It means there's no one-size-fits-all solution. A huge multinational bank like JP Chase faces very different money laundering risks than a small 2-person brokerage in a suburban town. Rule 3310 says you have to tailor your program to your specific business model. You can't just download a generic template from the internet and call it a day. You have to actively assess your unique vulnerabilities. Who are your customers? What products do you offer? Where do you operate?
And one of the biggest components of this is the CIP, the Customer Identification Program. This is basically know your customer, right? KYC.
Yes, KYC. It sounds so basic, doesn't it? Verify the identity of the person opening the account. Get their name, date of birth, address, and an ID number, like a social security or passport number. But as the source material shows, failing to do this properly can be absolutely catastrophic.
And we have a massive example of this right here, the Wells Fargo case. This seems like a perfect example of what happens when a risk-based approach goes horribly wrong.
Oh, it's a textbook example of a system failure, and specifically a failure of automation. The source details that Wells Fargo, like any big bank, had an automated system to verify new customers, which you need, right? You have millions of customers. You can't have a person check them all by hand.
Sure, that makes sense.
But there was a glitch, a really specific logic flaw. If a new customer was assigned a recycled account number, an account number that had been used by a previous customer years ago and then put back into the pool.
Which happens all the time.
All the time. But the system saw the number and assumed, because that number had been verified in the past, that the new customer was also verified.
So it just skipped the check entirely.
It skipped the check. It effectively said, oh, I know account 12345, that's a trusted account.
Yeah.
Not realizing that account 12345 now belongs to a completely different unknown person.
And this wasn't just a handful of accounts that slipped through.
No. The documents say that as a result of this flaw, nearly 220,000 accounts went unverified.
220,000. That is the population of a small city of completely unverified people operating inside one of the biggest banks in the country.
It's a gaping hole. And because of that massive oversight, they were fined $1.5 million by Finora. It just shows that automation is great for efficiency, but if the underlying logic is flawed, the vulnerability it creates is enormous.
Another key tool for the watchdogs is the SAR, the Suspicious Activity Report.
This is the alarm bell. This is how law enforcement finds out about this stuff. Firms are mandatory reporters. If a transaction involves at least $5,000 and the firm suspects it involves illegal activity, or even that it's just designed to evade the Bank Secrecy Act.
Like structuring deposits.
Exactly. They must file a SAR with FinCEN, the Financial Crimes Enforcement Network.
And they have a strict deadline, right? They can't just sit on it.
30 days. From the date of detection, you have 30 days to file. You can't wait and see how it plays out. You have to report it.
So what actually triggers a SAR? What are the red flags that Finora tells firms to look out for?
The source lists several. We've already talked about structuring. Lots of transactions just below that $10,000 threshold. That's a classic red flag. But there are others, like something called wash trades.
Explain wash trading to me.
That's a term from the securities world. It's where a customer buys and sells the same security over and over again, very rapidly. Or they might engage in prearranged trading with another account they control.
So if I buy Apple stock, then sell it 10 seconds later, then buy it back, and I do that 100 times a day.
The system should flag that.
Right.
Because you're losing money on commissions and fees every time you do it. It makes no economic sense if your goal is profit.
I see.
But if your goal is to create the illusion of high trading volume, to manipulate the price of a stock, or simply to move money around and make it look like legitimate trading activity, then it makes perfect sense. So if a firm sees a customer consistently losing money just to move the same stock back and forth, that is a huge red flag.
Then there's just illogical activity.
Right. This is the common sense flag. If a customer who stated their income is $30,000 a year suddenly starts making million-dollar wire transfers to offshore accounts,
You should probably ask a question.
you have to ask a question. Or if a customer is engaging in incredibly complex options trading that has no apparent business purpose and seems totally out of line with their stated financial sophistication, the firm has a duty to say, this doesn't add up.
And the sources also highlight the importance of independent testing. It's not enough to just write the rules. You have to test them to make sure they actually work.
And we have a case study for this too.
Yeah.
A much smaller firm called North Woodward Financial.
Right.
They're a small firm. They used a template for their AML program, which is allowed. But the problem was they failed to actually test the program for 3 years. They just wrote it, put it in a binder on a shelf, and assumed it was working.
They checked the box but didn't actually do the work.
Exactly. And they got hit for it. FINRA fined them $25,000. Now, that's obviously a lot smaller than the Wells Fargo fine, but for a small firm, that is a significant penalty. The lesson is that you cannot just pay lip service to compliance. You have to be able to prove that your systems are actually being tested and that they work.
So when we step back and look at all of this, from the street-level drug sales to the peso brokers in Colombia to the real estate agents in Australia and all the way to the compliance officers at Wells Fargo, it really is this continuous high-stakes cat-and-mouse game.
It is a constant arms race. Every time the regulators tighten the screws, like when they expanded the AML-CFT Act in New Zealand and Australia to cover real estate agents, or when FINRA enforces stricter CIP rules in the U.S., the criminals just evolve.
They move from simple cash deposits to something as complex as the black market peso exchange, or they move away from cash entirely into complex crypto layering.
Or they find new sectors with less oversight. Luxury goods, art, high-end collectibles. The money is like water. It will always find the crack in the dam.
And connecting it all the way back to the beginning, back to that washing machine and the black market peso exchange, it just raises a really provocative thought for me.
What's that?
If that entire massive, efficient system relies on buying legitimate goods washing machines, televisions, electronics, cars to clean the money, how much of the regular, legitimate global economy is actually being propped up or at least influenced by illicit funds?
That is the deeply uncomfortable question, isn't it? If you're a consumer and you buy a discounted appliance, is it discounted because of a normal sale or a supply chain efficiency? Or is it because a cartel broker needed to liquidate his US dollar inventory quickly to get his pesos back home?
And you would never know. The consumer, the manufacturer, maybe even the shipping company, they're all just participating in what looks like normal commerce.
It really makes you think twice about the why behind the transactions we see happening all around us in the world every day.
Absolutely. The underworld isn't some separate planet. It is woven deeply into the fabric of the upper world.
It really is.
Well, that is a heavy thought to leave you with. But next time you read a headline about a sudden property boom or a confusing trade deficit, maybe look a little closer. You might just spot the laundry cycle in action.
Always follow the money.
Thanks for listening to this deep dive. We'll catch you on the next one.